Hi, this is Ian Gendler, Director of Research at ValueLine. Today, using our digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going further, I'm going to recommend one stock to buy right now. After presentation, we have allotted time for questions and answers. Also, if you would like to revisit this presentation at a later date, it will be posted on valueline.com and our YouTube channel within the next 48 hours. For those joining us for the first time, I'll provide a brief overview of who we are at ValueLine. We are a New York headquartered corporation that is providing investment research for more than 85 years. Our is the ValueLine Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by ValueLine's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, ValueLine has no investment banking business with any company, including the 1,700 included in this service. ValueLine does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our professional securities analysts are not permitted to own shares of any company that they cover. I want to start the formal presentation with an update on the current economic environment. This content was created by Harvey Katz, ValueLine's chief economist. The unsettled global situation is now front and center. True, the trade dispute with China is nothing new, but we did think that the respective sides would work towards a détente of some sort. Now, we are less certain, with neither combatant showing sustained efforts at compromise, while escalating tariff threats. There are fewer headlines being made domestically, though here too concerns surface periodically. To wit, our previous forecast of 2.2% growth in the second quarter was rather succinct as GDP gained 2.1%. Going forward and weighing the assorted variables, we sense growth will remain understated. One area of concern is the recent drop in yields on the 10-year Treasury note and the corresponding rise in yields on the 2-year note. At times, this inverted yield curve, in which short-term paper yields more than longer-dated issues, can signal impending recession, as investors shun shorter-term paper out of fear business conditions will deteriorate. But while inverted yield curves all recent recessions, they also have predicted downturns that did not materialize. For now, we think the recent inversion may be sending a premature signal. Looking ahead, we think the business backdrop is comparatively healthy, especially given the second quarter's acceleration in consumer spending and the solid August retail showing, in which sales jumped 0.7%. Thus far, consumer sentiment has been dented just a little by the to and fro of planned tariffs. The willingness of the Federal Reserve to move towards an even more accommodative monetary stance, with possibly 2 more interest rate cuts this year, should help industries, including housing, retail, and business equipment. Such an outlook suggests that some of the factors needed to sustain the economic upturn are still in place. Overall, we expect growth in the neighborhood of 1.5% to 2% for the coming years, with greater average strength earlier than later, which is logical given the extended duration of this expansion. In sum, we believe it should focus on the healthy fundamentals now in place and the decent long-term outlook, and look beyond the short-term upheavals that can affect day-to-day trading. We can use Harvey's comments and outlook to create an investment strategy. Thankfully, ValueLine provides the tools to put this in action, which I will demonstrate when we get to the screener. Before we formally start our search, please note that I'm already signed in as a subscriber and on the dashboard. From here, I can access all the products, as well as view daily market commentary, economic information, as well as general interest articles written by our analysts. Let's now start a search for a worthwhile investment candidate. For this, I'm going to head to the screener, which can be accessed via the Find Ideas tab. You can also head to the screener right after you sign in. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. For today's search, let's focus on several details that Harvey mentioned in his report. For instance, he prominently mentioned the trade war with China and the unknowns involved, particularly if or when a deal is consummated. Thus, I'm going to start with focusing on companies only headquartered in the United States. For the most part, and there are exceptions, but these companies generate the majority of their revenues domestically. So I click on Country of Domicile, and then select United States. Next, Harvey urges investors to focus on the healthy fundamentals now in place. For this, let's make sure our candidates have been successful growing profits and utilize the EPS growth 5-year field. I'm going to set the low threshold to 15%. So these companies have been able to advance profits, on average, by at least 15% over the past 5 years. Historical growth is important, but I also want to make sure that the companies are positioned to continue to perform. This is where Value Line's 3 to 5 year projections are particularly useful. This is also a good time to mention that Value Line is one of very few research houses that provide financial projections out 3 to 5 years. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. So simply click on the projection field, and I'm also going to set the low end to 15%, which is a healthy expectation. Just as a quick recap, so far we have a list of U.S.-based companies who have achieved healthy earnings gains and appear likely to continue that strength. Now let's focus on the stocks in particular. Of course, I want to find equities that are expected to outperform the broader market, and for this exercise, we're going to focus on the longer term. For the next field, I want to utilize a new feature from Value Line, and it is only available to our subscribers. It was developed by our in-house quantitative research team. The 18-month target price range, as the name suggests, seeks to predict the stock's price over an 18-month horizon in terms of a range. In addition to the high and the low values of the range, the percentage difference between the current stock price and the midpoint of the range is provided. The percentage may be thought of as the most likely profit. The larger the percentage, the greater the possible price appreciation. The 18 target price range is only available for the 1,700 stocks covered in the Value Line Event Survey, and this purely quantitative measure is displayed on our digital reports. We have also added the 18-month midpoint percentage to our stock screener so we can use it today. For the midpoint, I'm going to set the low end to 25%. Thus, according to this measure, the most likely scenario calls for the following stocks to increase in price by 25% in 18 months. My final field will look even further into the future. Tapping Value Line's proprietary estimates again, I'm going to utilize the projected 3 to 5 year annual percent total return for the low end. This shows the low end of our stock price forecast on an annual basis. I'm going to set the low bound to 10%, which has to be entered as 0.10. Thus, these equities are expected to achieve, on average, a 10% total return each year out 3 to 5 years. All right, we're down to just less than 20 stocks, which is manageable. All of these stocks may fit nicely in an equity portfolio that is focused on the longer term. However, only one can be today's one stock to buy right now, and after conferring with several of my analysts, I'm going to recommend Domino's Pizza, ticker DPZ. Before I dive into Domino's, Please note that screens can be saved and revisited later by utilizing the button at the top. Clicking on the company name to the equity's digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, or hidden, so you can create your own My Stock report. Once I alter the presentation to my liking, I can save changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. I can also apply these changes to other equities. Domino's is a household name, but let's quickly get some corporate information from the Business Overview module. The Michigan-headquartered corporation is the large pizza delivery company in the United States. Importantly, especially as trade and tariff concerns linger, Domino's generated 93% of its revenues domestically. Thus, it is almost entirely insulated from international affairs. Admittedly, it's one of the main reasons why DPZ was chosen rather than any of the other 18 or so candidates. Moving on, our digital reports possess a great deal of information and analysis, and I can't cover all of the useful modules. However, I do want to discuss a few features that highlight Domino's favorable prospects and investment merits. Let's first look at institutional ownership. And by clicking on the double arrows, you can expand the module to solely focus on it. Getting an idea as to how the hedge funds and investment banks feel about the stock can be helpful. As you can see, over the last 3 quarters, institutional buys have exceeded sells, which is of course a good sign. Moving to the valuation module, we see Domino's historical annual performance as well as Value Line's estimates for this year and next in bold. A quick scan reveals that Domino's should continue to increase revenues, earnings, cash flows, and other metrics at good clips. Clearly, from a numbers standpoint, there's a lot to like here. But sometimes the numbers don't tell the full story. So I now want to highlight our classic PDF reports, which are available for all digital subscribers. They're available using the button here in the top right. This report was just written by senior analyst Richard Gallagher. And I'm going to look at the analyst commentary, which many of our subscribers believe is the most important part of the page. Here's an excerpt. Shares of Domino's Pizza have been on a roller coaster ride of late. After registering a nice advance prior to our May review, DPZ has fallen roughly 15% in price. The main reason for the pullback is disappointing results in the June quarter. Sluggish traffic trends and weaker than expected same-store sales growth were expected. Discounting in the market, an uptick in competition, and some lost sales due to management's fortressing strategy, which are investments to shore up existing markets, were largely to blame. There was some good news. Earnings of $2.19 a share easily beat our target of $2.10, as well as the consensus on Wall Street. Lower taxes, coupled with retail sales growth, led to a strong bottom line tally. All told, it's been a bumpy ride for DPZ's investors over the past year, which has followed an enviable run-up, which we can quickly see in the graph. Recent investments should bear fruit in the years ahead. The company has investing in bolstering its domestic business while continuing to expand abroad. Further, it has made a big push of late with its loyalty program, which should be a positive. Therefore, the top and bottom line should get back on track in 2020. All told, Domino's is well positioned for the long haul. As for the stock, near-term investors would do better to look elsewhere. However, longer-term investors may want to consider DPC shares. After the recent pullback, the equity offers attractive recovery potential over the 3 to 5 year pull. Specifically, Domino's is now trading at around $228. Our 18-month percentage, which you can see up here, is a lofty 55%, suggesting that the stock may well increase sharply by that time. Further out, our 3 to 5 year target price range now stands at $345 to $520. All told, Domino's Pizza, ticker DPZ, appears to have plenty left in the tank for the long haul, and it is today's one stock to buy right now for patient investors. This marks the end of the formal presentation, and I will now tackle your questions. You wanted to pull up the questions? First question, is historical 18-month target price range information available for the stock? Well, we just launched this a few months ago, so it's not something we publish. I will tell you that we've done extensive back testing before we provided this to our subscribers. And looking back, somewhere between 2/3 and 75% of stocks fell within our 18-month range 18 months later. Next question. Is the portfolio tool going to return? Yes. I will apologize to our current subscribers that were using that tool and it malfunctioned and offline for a few weeks. However, it is now back up and running as of last night. You can take a look at that. So for those of you that rely on Portfolio Tracker, it is back up and running. Why recommend a stock that only gets a 3 rating for timeliness and safety and a B- for quality? Let's go back to Domino's and I'll tackle those questions. First off, in regard to timeliness, it being a 3, which for those of you that don't know, 3 is average. And this measures the stock's potential performance over the next 6 to 12 months. However, today's screen and Domino's was all about the long term, far beyond 6 to 12 months. It's why timeliness was not one of the variables in my screen, nor did I use it in any of my valuation techniques today. As far as 3 safety, 3 is average. We don't consider 3. Domino's has no really volatile company, certainly not above average in volatility. And B for financial strength is actually a little bit below average, but not a concern. DPC has a lot of debt and negative equity. Can you comment? Yeah, let's take a look. So if you look at our reports, you can see that Domino's, for shareholders' equity, the D stands for deficit. The Domino's pretty much always has negative equity. A lot of that stems from the repurchasing of shares. They spend cash, and that, while it increases shareholder value, it takes a bite out of equity. A lot of companies are doing this. 2018, because of the tax cuts and the favorable economy, I believe it was the best year for stock buybacks, meaning the most money was spent on buybacks. So I don't consider that a concern, negative shareholders' equity, which, of course, when you have debt and negative equity, your debt to capital is well over 100%. Do you still like Argo? Yes. For those of you that don't know, I highlighted Argo last month as the one stock to buy right now, and I still recommend it. All right. Any thoughts on Lockheed Martin? Sure. For those of you who don't know, I personally track Lockheed Martin and Boeing in the aerospace defense industry. We're actually in the process of finalizing a new Lockheed Martin report that will be posted on our website on Monday. Obviously, I don't want to give away anything to people that are not on this call, but I will say Lockheed's fundamentals remain excellent. But for more details, I would check back on our site come Monday. Next question. Are you still positive on Cabot Microelectronics? Well, let's take a look. Admittedly, I can't follow every stock every day. I can tell you we just put out a new report on CCMP. So if you want the time on this rank, obviously it's ranked favorably. It has a good midpoint of 20% out 18 months. And its 3 to 5 year target price is also nicely ahead of the current price. We could take a look at our classic report, maybe get some analyst information. And indeed, it holds worthwhile total return appreciation. We are still recommending Cabot Microelectronics. Is there a way to go back to the screener page once you have clicked on one of the stocks, that is, without redoing the screening? As I mentioned, you would save your screen first. If you do navigate off it and go back without saving, you will have to enter the criteria again. Here's a question. Why does Value Line report annual rates of change per share as opposed to just absolute changes? That's referring to the annual rates box. It is indeed on a per share basis. To be honest, I don't know. It's the way we've always done it. I guess it's probably a way to, because changes in shares outstanding is so common with companies issuing shares or buying back, that we show it on a per share basis. And of course, when companies report earnings, the earnings per share number seems to be more important than the profit number, as is dividends, for instance, about how much dividends you're getting per share, rather than the total dollar value of dividends. But admittedly, that's me spitballing top of my head. Looking at it both ways are, I would say, just as important one way or the other. Here's a question about now being automatically logged off after about 15 minutes. Are other subscribers having similar issues? Yes, if you're idle on the site, I believe it's 15 or 20 minutes, you will get logged off. That's for security reasons. Your economists have downplayed inverted yield impact when lots of press focusing on it. How solid is this assumption? Well, this is our economic view. Harvey Katz has been doing this for 40 years. You know, he's definitively 100% right. Of course not, but we're using the best information we have and our experience to create these assumptions. There is admittedly some guesswork. It is an art, not a science. All right, that appears to be all the questions for today. I want to thank everybody for tuning in and for asking questions. Thank you very much, and have a great Labor Day weekend.